What if I told you that you could boil down the complexities of value investing into just two simple metrics? Well, today, we're diving into the magic formula, a legendary strategy from a master investor that promises to do exactly that. It's all about finding fantastic companies at bargain prices, so let's get right into it.
And this quote right here from the creator of the formula, Joel Greenblatt, really gets to the heart of it all. See, he's saying that the market can be kind of crazy and emotional in the short term. He calls it Mr. Market. But in the long run, value wins out. If you've done your homework and figured out what a company's really worth, the market will eventually catch on. The whole game, then, is getting that valuation right.
And that's exactly where the magic formula comes in. Greenblatt wanted to cut through all the noise, all the chatter, and just focus on what truly matters. This isn't about some complicated black box algorithm, it's about a fundamental mindset, a way of looking at the world.
And here it is. This is it. This is the big question. Every single investment decision you make, according to this strategy, boils down to this one simple two-part question. Seems almost too simple, doesn't it? But really mastering both halves of this question is the absolute key to everything. So let's break down what each part actually means. Okay, first up, the good price. How do we even know if we're getting a good deal? A lot of people just glance at a stock price or the PE ratio, but the magic formula uses something way more powerful. And that something is called earnings yield. Now, instead of just looking at the price of a single share, this looks at the whole business. It takes EBIT, that's just earnings before you worry about interest and taxes, so it's a clean look at profit, and it compares that to the enterprise value. Think of enterprise value as the price tag if you wanted to buy the entire company, debt and all. This gives you a much more honest picture of the bargain you're actually getting.
So you might be asking, hey, why not just use the good old PE ratio? Well, because the PE ratio can lie to you. It totally ignores a company's debt. So one company might look super cheap on a PE basis, but it's actually drowning in debt. Another might look expensive, but it's got a fortress balance sheet. By using enterprise value, earnings yield lets us compare apples to apples no matter how a company is financed. It's just a better, more honest metric.
But look, finding a good price is only half the battle. A cheap price on a crummy business is just a crummy investment. That brings us to the second and just as crucial part of the question: how do we find out if it's actually a good business?
For this, the formula uses something called return on tangible capital. And this metric is frankly brilliant. It takes that same EBIT, those pre-tax profits, and it compares them to the actual physical capital needed to run the day-to-day business. We're talking about stuff like inventory and factories. So in other words, it answers the question, for every dollar of real stuff the business has to own to operate, how much profit does it spit out? A high return here tells you found a truly high-quality, efficient company.
And that's it. That is the magic formula in a nutshell. We're on the hunt for that perfect combination, that sweet spot. Really great businesses, which we measure with return on capital, that happen to be selling for a cheap price, which we measure with earnings yield. That's the bullseye. Now, all this theory is great, but let's see how it actually plays out in the real world. Let's make it tangible with a super simple example. We're going to look at two businesses to see why that good business part is so incredibly important.
So let's meet Jason and Jimbo. They both scraped together $400,000 to start their own business. 1 year later, Jason's gum store has cranked out $200,000 in profit. Jimbo's Just Broccoli, well, he only managed to make $10,000. Same money in, but wow, wildly different results.
Jason's store is a home run. It's a phenomenal business. A 50% return on capital, that's $200,000 in profit from a $400,000 investment. This thing is an absolute value-creating machine. Every dollar he puts into this business generates a massive return. This is exactly what we mean by a good business.
Jimbo's, on the other hand, it's a different story. His 2.5% return is awful. Just think about it for a second. If you can get, say, a 5% return on a super safe government bond, then Jimbo isn't just underperforming, he's actively destroying value. He would have been better off doing nothing. This is the classic value trap that the magic formula is specifically designed to help you avoid.
Okay, so the formula seems pretty straightforward, right? Buy businesses like Jason's, avoid businesses like Jimbo's. But here's the catch, the crucial point. You can't just blindly plug in last year's numbers and call it a day. Any business can have one really good year or one really bad year. This is where investing stops being a pure science and starts becoming an art.
And just as Greenblatt himself says, this is the art part. You have to use your brain, your judgment. The numbers are the starting point. They're not the finish line. You have to look beyond the spreadsheet and actually understand what's going on.
So what does this art part look like? Well, it's a process called normalizing the earnings. You have to ask yourself, what would this company earn in a totally normal, average year? This means you have to mentally smooth out the bumps. You adjust for weird one-time events, you think about where we are in the bigger economic cycle, and you try to arrive at a best guess of the company's true, sustainable earning power.
So we've broken down the formula, we've seen it in action, we've even talked about the art of applying it. But there is one last piece to this puzzle, and honestly, it might be the most important part of all. It's the one thing the numbers will never, ever give you.
And here it is. This is the ultimate takeaway. The real magic isn't actually in the ratios themselves. It's having the discipline and the patience to stick with the strategy, even when the market is screaming that you're an idiot. History shows us there can be long, painful stretches where value investing just doesn't work. The biggest risk is giving up right before it's about to pay off. The formula only works if you have the guts to see it through.
So I'll leave you with that question. The formula itself is incredibly simple. Find good businesses and buy them at cheap prices. But having the discipline, the emotional fortitude to stick with that simple logic when everyone around you is panicking or chasing fads, well, that's the real test of an investor. Thanks for joining this explainer.